Welcome to the Yorkshire Shadow MPC, a partnership between Clive Owen LLP and the York Press. Well, inflation stands at 5.5%, and depending on which report you read, it could hit double figures by the summer. There's a dilemma. Does the Bank of England raise interest rates to try and tackle inflation, or will higher rates just add to the current cost of living crisis? We're going to see what our Shadow MPC members think. They're from different businesses around Yorkshire. And by the way, there are other things to take into account. For example, there are more people in work than there are vacancies by a country mile, but there are more vacancies than there are people available for work. Also, don't forget that lots of families have savings in the bank. Let's see if those things enter the equation when people consider the interest rate dilemmas that are on. I'm going to firstly go to Gary Smith. Gary's from Tilney Financial Advice you provide, Gary. Tell us what your view is on the state of the economy.
And it's a bit of a strange one, to be honest, at the moment. So the year started off with markets around the world probably falling by over 10%, with the worry about rising interest rates and quantitative easing being stopped predominantly in America, and how that affected the rest of the world. So that was already creating an issue. And then Russia invading Ukraine has obviously created more turmoil in the markets, with the worry about rising oil prices and how that will affect inflation moving forward. On the flip side, we still see an appetite for people who have cash to be funding their pensions in their ISAs at the moment. So although there is volatility, it does create a buying opportunity if you're taking a medium to long-term view. But when I am speaking with my clients, although they have had good years, they're definitely concerned about rising costs. I was speaking to someone on Friday who works in food manufacture. They import their food from Europe, and the price of meat went up 33% last week, and it is expected to go up a further 33% this week. Aluminium, Russia was the largest manufacturer of aluminium that's used in cake and pie tins. So you can imagine, if we can't access those, the costs of sourcing it from somewhere else is also going to lead to costs rising. So I think in terms of where we are, inflation certainly will not come down as expected because of the rise in price of oil. Hopefully Boris Johnson can have some positive discussions with OPEC, which will lead to increased production of oil, which will hopefully stop the rapid rise. Because if you go and put fuel in your car later on today or this week, you'll probably find that it's going up every day, and by 4 or 5p every day. So it's it is going to be quite painful. The GDP figures for January were very strong, which again probably gives the Bank of England a bit of pressure to put interest rates up when they meet later this week, because the economy is doing well. Whether or not that will continue to be the case as the national insurance rise comes through, council tax rises, and the already anticipated fuel to gas and electricity bill rises in April will remain to be seen. So at the moment things are okay, but there are definite headwinds which people need to be aware of.
Okay, well, that's an interesting and thorough analysis, Gary. I'll come back to you and square that analysis off in a minute when we go to the issue of the interest rates. Jessica Russell's on, and now Jessica works for Castle Recruitment. We were talking about jobs. I mentioned at the beginning there are fewer vacancies than people chasing jobs. Is this affecting wages?
Yeah, we've definitely seen a wage increase, and sometimes up to 7% dependent on industry. We're seeing the biggest rise within the manufacturing and engineering sectors across Yorkshire at the moment specifically. There's still quite a bit of candidate confidence out there. We are still seeing candidates looking to make the move, but they are now starting to consider what the next 6 months holds for them personally. I guess in their purse, so to speak. So they are haggling quite hard in terms of pay rises. And not only that, but they are really starting to look at pension contributions. So we're advising employers at the moment that are recruiting, if they are looking to attract candidates where they've got so many offers on the table at the moment, is to really pay attention to those additional benefits that might supplement annual salaries. But confidence is still there. but it is very much a candidate-led market at the moment.
And what about confidence on the other side with vacancies? Now, you were talking about those specific areas, Jessica. In my own business, which is PR business, I have talked to 2 companies who've decided to freeze vacancies now because they're worried about headwinds.
We're not seeing that at the moment. Now, whether that happens over the next 2 to 3 months as people are affected more, because the rise of raw materials, the cost of raw materials is obviously increasing, that is going to start having a really big knock-on effect over the next few months. We are starting to see in some industries, engineering and manufacturing, because of the increase of raw materials, and it is having an overall impact on cash flow in some instances. That will absolutely put a dampener on recruitment, but I would say we're probably holding steady for the next 2 to 3 months.
Thanks, Jessica. Let's go round the board again, and let's go round to Richard Peake. Now, Richard, at Helmsley Group, you're involved in property investment. The property market is still hot, isn't it? If I wanted to sell a house now, I could still take advantage of quite a few buyers.
No, absolutely. Yeah. The market, today is very buoyant. We're seeing a lot of interested parties for the projects we're involved with. I do worry, in fairness, whether that's going to continue on at the moment. I think the recent events in Ukraine are going to spook a lot of people in terms of what's going on. When you couple that with the inevitable sort of the price rises across the board. It is going to be a more difficult time for people. I think, we also act for a number of client investors who look to sort of seek a return through us. And I know from speaking to a few of those over the last week or so that they are just looking at their sort of investment criteria and whether they are going to, in effect, put a little bit under the mattress for potential rainy days that might be around the corner. We were just speaking in our office just earlier today about sort of how we feel the market is going, and I do think that Mr. Sunak and Boris are going to potentially have to look at trying to put some more sort of support measures in place over the coming months, because that might ironically lead for a mini boom. But I think we were talking before going on air about the potential for a recession at some time in the future, and I think that's something we just have to be very conscious of. We might have a reasonable 12 to 18 months, but without wanting to be doom and gloom, I think the medium term picture could be quite quite difficult. So I think.
Well, Richard, you're the first person to mention the R word. I was reserving it for questions later, but
apologies.
Of course, recessions aren't good in property, but property in the longer term, they're not making more land, are they? And bricks and mortar has been a traditional receptacle of investment funds.
Yeah, no, I think we are still seeing it is the safest bricks and mortar, isn't it? The old expression. So I think people will just take a lot longer to sort of make that decision, or just decide what their strategy is going to be. 2 weeks ago, if we'd have been having this 2 or 3 weeks ago, I would have been incredibly positive about the future. I think, but the recent events are just.
It's very interesting because the data that we were talking with Gary about, that is actually 3 or 4 weeks ago old, isn't it? The end of January, the data. So things have changed. Well, Richard, thank you. Let's go to the next person on the patchwork there. It's Dave Broadbent. So Dave, tell us a little bit about your business and how you see it.
Yeah, well, I'm the resident insolvency practitioner. I run a firm from York and Teesside. Excuse me. I was commenting the other day to our own regional managing partners, because in 25 years of doing insolvency work, February was the first month where we dealt with 30 insolvencies. The number of insolvencies that are occurring at this moment in time are continuing to rise. I did a seminar, an online seminar last month, which produced a graph. And you can physically see the numbers of insolvency dropping over the duration of the various lockdowns we've just experienced. But since probably about October last year, there's been a slow, gradual increase. What's the reasons for those business failures? A couple of things, really. Last time I was on, I was talking about bounce back loans. Pretty much 1 in every 3 jobs that we're doing at the moment is just simply driven by bounce back loan. They came into force April, May 2020. they managed to kick the can down the road for a couple of years, but now it's biting, and people just can't afford to repay them back. So we're effectively seeing about, I would say, about 10 of those a month, and the numbers that are being written off are somewhere between £30,000 and £50,000. Other reason for businesses struggling at the moment is just lack of work. There's, we mentioned off air about vehicle sectors. Some of the vehicle sectors that we've got at the moment, the guys are just saying, we've got no idea what it's going to be like for the next 6 months. Anything that has any sort of linkage towards fuel, petrol.
Semiconductors in the case of cars being sold as well.
Absolutely, yeah, absolutely. And not only that, I think what people are now starting to do is they're looking at the social media, they're seeing there's a lot of concern out there. So the automatic response to that is to just not spend.
Okay.
People are still...
Sorry, I just wanted to ask you one more thing about CBILS. Now, you mentioned bounce back loans. I was talking to a larger business that had CBILS loans. Now, they were repaying and are repaying their CBILS loans on a quarterly basis with large lumps of money, so they're getting on with repayments. But there will be a cliff edge when the loan is due. Is there a case, particularly for the large loans, maybe not so much for the smaller ones, but is there a case for the government to extend the term? For good payers, maybe not for bad payers, so that you don't have a moral hazard issue.
I think the problem that you've got is because a lot of these, everybody forgets that all of these loans were backed by guarantees provided by the government. So effectively what they'll be doing is, at this moment in time, I think the provisions that are being put forward are around about £20 billion already for the amount of bounce back loans in particular and CBILS that aren't going to be collected in. So if people are asking the government to step in and elongate it out, that's going to put a lot of pressure on the banks. Because from their perspective, it's going to be those people that will not be able to effectively recover the monies. As awful as it sounds, if you were a bank, if you were a lender, and you said, well, I've got one of two alternatives. I can either try and support a business at the moment, elongate it, stretch and put myself under the pressure, or just simply say no and hope that the company has to go through some sort of restructuring procedure, which would then allow them to claim under the guarantee scheme. It sounds incredibly mercenary, but there are a lot of banks out there that are very nervous at this moment in time, looking at the numbers that they're not going to be recovering back.
Sorry, go on, finish point.
No, I was just going to say, and I think it is. I mean, Richard mentioned the R word earlier. I've been saying for the last 2 or 3 years that pre-pandemic, we were close to coming into a recession at that point, early 2020. It was only really by the skin of the teeth that we managed to stay positive for 2 GDP for the 2 quarters beforehand. But I think with that, it needs a flush. Okay. The entire economy needs a flush.
All right, thank you, David. Let's go to Rob Whitehead. Now, Rob, it is your job definitely to cheer us all up here, okay? We've just heard from Dave. He's great, but he's a gloomster. Rob, what have you got to say? What are the clients of Clive Owen LLP? What are they saying about their trade at the moment?
Well, it continues to be a mixed bag, to be honest. I mean, there's a lot of businesses have been very profitable over a number of years, and obviously took a dip in the pandemic, and then saw an increase in business coming out of that. And we're talking quite positively about this year ahead. Obviously, the last few weeks, we've lurched from the Brexit to pandemic to the Ukraine situation. So I think there's still a lot of uncertainty out there.
But surely the businesses, you'll know better than me, but businesses are still got, with the exception of those that have these CBILS loans and so on to pay back, there's quite a few businesses with large cash reserves. Isn't it are businesses yet considering spending them or investing them?
No, I think that's right. There's a lot of businesses with cash out there, and there's a lot of investment planned. The labour market is people are looking at automation to help with, labour shortage. So investing in plant and machinery, and obviously there's still a lot of incentives, capital allowances, super deduction. There's a lot of incentives for investment out there. Still a lot of businesses looking to sell, a lot of businesses looking to buy, bolt on businesses to their current situation. So there are some positives out there. Obviously, the general picture is rising costs, supply chain issues.
Okay. Well, before you take us down that rabbit hole again, because you're right, Rob, it is a mixed picture. Shall we just bring Steve in from NewsQuest, who of course own the evening, the press, the York Press. Steve, what are your advertisers doing? How are things going when it comes to sales? Because you're a really instant sort of yardstick of what's happening.
Up till now, the last 8 weeks have been positive. All the restrictions coming off have meant that businesses have felt optimistic for the first time for 2 years. Most of them are on a customer re-engagement plan to try and get customers back into the high street and back into the shops. I think we know there's a real pressure on rents. People are renegotiating their rents with their landlords down because they've got the power to do so because people have gone online. So that's putting a bit of pressure on the landlords that own retail properties. Like Jessica said, we've seen the recruitment market remains very buoyant with the candidates driving up costs. But the big issue that we're seeing is the cost of raw materials going up. Petrol, we talked about. In our own business, we've seen a 30% increase in our raw print materials that impacts on what we do. And our customers are seeing their costs go as well. And to be honest with you, up till now, the conversation with most of our customers is getting back to life as normal post-pandemic. And everything else seems to be a little bit that it's in the background, but we don't want to talk about it yet. We want to worry about that now.
I was out shopping in York just 2 weekends ago, and it was humming on a Saturday. And I was talking to one of the HSBC economists who was saying that if you look at a basket of economic predictions, they think interest rates could hit 1.25% this year. And then he said in a very tangible way, if you've got a family who've built up some savings during the lockdown, and more than 50% of families do have savings now, then you're not going to persuade them not to go and spend after being locked away with restrictions for so long.
Yeah, so what we saw in lockdown is home improvements was buoyant. People did a lot of work at home, but what we're now seeing is that's moving into the leisure market. Mm-hmm. People are starting to weekends away, shopping, theatres, cinemas are all buoyant now. So people are starting to get out and about again.
Okay, let's move to our next speaker, and we've got on the panel next Jill Gibson from GSM Group. Just remind us what you do and tell us what sentiment's like at your business.
Hi, I'm representing the manufacturing sector, so we've been pretty much hit by most of the things you've discussed so far. In terms of order book, our order book is as strong as it's ever been. There is huge demand at this moment in time, but that gives us ongoing pressures from recruitment. We just cannot get people in, and people that will stay. We've really had an issue with that. And people's expectations now of their salaries are so much higher. We're having to go to recruitment agencies for just people on the shop floor, which historically they would normally come straight to us. So we've got increased recruitment fees, and they're wanting sort of 5 to 10% higher rates than we would traditionally have paid. So that's really affecting us. We're responding by investing. We're investing quite heavily in automation, taking advantage of the super deduction. But from a raw material perspective, you mentioned about aluminium earlier. Stainless steel, Russia is the second largest stainless steel exporter, and that has really affected the price of our raw materials. And so we're having to buy quite a lot of stock to ensure that our customers will be satisfied later on, and we're not passing too much of the cost back on. But new projects coming in might be impacted as people will pause projects to wait for things just to settle down. But we haven't got visibility of that at this moment in time.
And Jill, just remind everyone what you make.
So we make enclosures, metal enclosures, in one of our factories, and metal labels in another. Yes. So we're very heavily,
You fabricate metal, yeah. You fabricate metal.
We shoot metal. We're very dependent. Also on the chemicals. Ukraine actually are one of the world's only producer of ferric chloride, and so we can't get that at the moment. So that's really impacting our operations. Yeah, it's tough. It's tough business.
It was a big reality check. We've had a great group today. We've got people in property. We've got people like Steve looking at consumers. We've got people like you in manufacturing. And then some of the experts. Rob seemed to call it right when he's saying it's a mixed bag. And it certainly is from this screen. So I'm going to the screen now. Before I call for a show of hands on interest rates, does anyone want to make an interest rate point? Okay, so quick show of hands then. If you were sitting at the real Bank of England Monetary Policy Committee this Wednesday and Thursday, who would vote to increase interest rates, albeit maybe by a small amount, but increase interest rates? 1, 2, 3, 4. Oh, overwhelming majority. Who would vote to keep them the same? 1. And obviously none of them would vote to reduce them. Very interesting. I came to Gary first. If you don't mind, I'm going to ask you to just sum up. What do you think? The sentiment is clear that people want to get ahead of inflation here. See if we can damp it down, because inflation has always been defined as too much money chasing too few goods. Is that still right, or is some of this inflation beyond the ability of interest rates to sort?
I think the reason why I said the vote for it is, prior to Russia invading Ukraine, the expectation was that the Bank of England would probably have to do one more rate rise just to control inflation. But then once the fuel costs, the national insurance and the council tax rises come in, that inflation would ease later in the year and take the pressure off. But the rise in price of oil is just going to make the situation far worse. So I think they're trying to get ahead of the curve. But once oil goes up, it's not interest rate rises that will deal with that. So I think it's the legacy of dealing with the inflationary pressures we already had that they're trying to deal with, get ahead of that before the implications of the.
And if I remember rightly, you were one of those people in the last year who wanted rates up earlier.
I was more of the opinion that interest rates rises wouldn't necessarily help, because the reasons for inflation weren't because people had more money to spend. It was more fuel costs, etc., and supply chain issues. However, still, the rise in price of oil as a result of a country invading another sovereign country, interest rates probably won't sort that out long term, but the inflationary issues that were already there, it needs to be tackled, because things are going to get ahead of themselves if the Bank of England don't tackle this sooner rather than later.
Can I thank everyone for joining us on this special Shadow MPC in association with the York Press and Clive Owen LLP. Thank you for joining us. We'll do another one of these in a couple of months.